And we're fortunate tonight to have Craig Christney here from Idea Lab, which was one of the original tech incubators in Pasadena, to talk about that very topic. So, Craig, the floor is yours. So I just got pocket NDA. I'm going to need each of you to do that. No, actually, that's a great idea. Just the other day, I was sending NDAs back and forth on email, and I was like, there's got to be a better way. So I typically don't like to sort of stand at the mic and use the mic, so I'm going to try to project. If you guys can't hear me in the back, I'll jump on there.
I actually need you on the mic for this.
Oh, you do? Okay. Well, I'm stuck then. As Mike mentioned, I'm Craig Christney. I'm the CFO of Idea Lab. I have been there for 17 years, believe it or not. I thought I'd start by giving you a quick background of myself. So I went to college at Cal Poly San Luis Obispo, studied business administration there, and knew from my freshman year what I wanted to do, and that was be an accountant. I know that sounds boring. And the idea was always to go work for a big company somewhere, a public accounting firm, and sort of stay in the big company arena. I never really saw myself working for small or medium-sized sort of startups, but eventually I ended up there. So spent 4 years at Cal Poly, came out and worked for Price Waterhouse, and actually worked there for 12 years. And during my time there, I worked mostly on entertainment clients. Most of the big studios are clients of Price Waterhouse, and was able to get a sense of basically how a studio works, which I'll come back to in a second, but it's basically having a portfolio of films. And so a studio will create 20 to 30 films a year with the hopes that one or two of those are huge successes that basically outsize the failures. And so that portfolio approach always stuck with me and is actually very relevant in the incubator or accelerator world. Let's see, while I was at PW, none of the ballots at the Oscars were ever mishandled, so I got that going for me. But anyway, I sort of in the mid-90s, the tech boom was just starting to happen, and I sort of got wind of the fact that maybe I should start getting some tech companies on my resume. And my wife, believe it or not, was working at Caltech, and she sort of put a bug in my ear about Bill Gross and Idea Lab and the fact that they were starting companies, and that they had a couple of companies, GoTo.com and eToys, that went public, and their shares were trading through the roof after they went public in the late 90s. And literally 2 months later, I was sitting in the office, and a partner came by and said, hey, Idea Lab needs to get audited. They want to go public. We're going to go bid on the account. And I just said, I am stepping forward. I want to be on that account. I want to run the account. For two main reasons. One, it excited me, to know an event, and I was very, passionate about what they were doing, and I heard about it from my wife. But two, that was the closest company to my front door. And after spending time at PW, traveling all over Southern California and commuting, 2-3 hours a day, I thought this would be a great fit. So I did sort of jump over at that point to help Idea Lab with putting together their S1 to file to go public. This was in late 99, early 2000. A lot of you out there are sort of too young to realize this, but it was right when the tech market was about to crash. So basically March of 2000, the whole world changed. Idea Lab was set to go public. We were getting ready to file an S1. And the tech market crashed. And so we actually did file in hopes that the market would turn. It never did. So we pulled the S1 and have remained a private company in our whole history. So that actually was a blessing in disguise. Had we gone public, we would have been sort of emboldened to the public community and probably wouldn't have been able to change course after the crash as quickly as we did. So it was actually a blessing. So that's a little bit about myself. What I'd like to do tonight is just give you a brief overview of Idea Lab and what we do. And in doing that, sort of share some stories with you about things that we've experienced in our 21-year history. And also sort of give you the overview of the incubator model and differentiate it between sort of co-working spaces and accelerators and a lot of the other sort of incubator-like entities, VC funds and whatnot that we see. So I'm just going to jump right in. So this is right here a picture of our front door at Idealab. We're right in the heart of Old Town Pasadena. We've got 35,000 square feet. That allows us to hold about 200 or so desks in our facility. About 35 of those are used by Idealab employees, and I'll get into sort of what all the Idealab folks do. And then the balance of the desks, so anywhere from 160 to 180 desks at the height, will be housed by our operating companies. And at any given time, we've got between 10 and 15 on-site companies that differ in size from the first week of the company with the first employee that has just started in our facility to a late stage Series D company that's generating 25 million in revenue and has 40 plus employees. Typically when they get to the size of the latter company that I just described, they're ready to move off-site. There's no sort of black and white time, but when they have 50 or so employees, they've sort of outgrown their space, and that's when sort of the incubator model takes effect and we kind of shoo them out of the nest and say, okay, it's time to stand on your own 2 feet. And our expertise is really in that sort of early stage, which is creation through the pre-revenue stage. When they start generating consistent streams of revenue, we still like to have, some day-to-day management and control of the company, but we sort of lose our day-to-day focus as they raise money and the VCs come in and more professional sort of board members come in. So our mission statement is to create and operate pioneering companies. We really are looking to challenge the status quo and really change the way people work. And I've got a slide that sort of goes through that. We treat all of our sort of partners, companies, employees, and community with respect. This is our sort of, Google sort of do no evil. It's sort of easier said than done, but we do obviously try to have a very positive impact with everybody that we come in contact with, which is, again, hard to do. But, the tech community and the Southern California community is a small one, so you always want to be sort of doing the right thing and making sure you make a good impression on people. Usually, everybody's interests are somewhat aligned, and so those decisions are hopefully easy to make. So you say that I say that we try to start companies that are disruptive and challenge the way people live, work, and think, and challenge the status quo. So these are just 3 examples. We've had over 160 companies in our history, but these are 3 of sort of the ones that are disruptive in different ways that I'd like to tell you about. So the first one is a company that started as GoTo.com. We put in a $250,000 seed investment back in '97. It was one of the first Idealab companies in our portfolio. And Bill Gross, our founder and CEO, was passionate about search and the internet. He graduated from Caltech and was looking at search and saying, well, wait a second, when I search for something, the order of the terms that comes back is chaotic. There's no order to it. He's like, I want the most relevant things first. I want to see, the advertisers that are most willing to get my dollars, come up first. And so he developed the whole pay-for-performance advertising model, which is basically when advertisers bid for keywords. And then the more that they bid for the keywords, the higher they come in the search results. It's obviously a model that Google's AdWords uses today quite successfully. But at the time that Bill introduced this model was at a conference in the sort of 97, 98 timeframe. And this was before there was a lot of advertising on the internet. So when he unveiled it at the conference, he was met with a lot of boos and a lot of jeers and a lot of people basically saying, this is basically going to ruin the internet because it's going to be flooded with advertising. He persevered. He didn't let that get to him. He sort of knew that he was onto a good idea, and so he continued to grow, raise VC money from several top-tier Silicon Valley venture capital firms, and really made GoTo into a worldwide phenomenon, a worldwide success, and created sort of the billion-dollar, multi-billion-dollar, I should say, paid search advertising model on the internet. That company went public, as I mentioned, in sort of the 98, 99 timeframe. Obviously enjoyed huge success during that early stage when the markets were very frothy. And they survived through the downturn. They survived through the market crash and were acquired by Yahoo in 2003 for $1.4 billion. So that $250,000 investment that we put in ended up being worth 100 times that investment at the end of the day. And so that is not only sort of one of our most financially successful companies, but probably our most impactful company that we've had in the portfolio. Another example is a company called Internet Brands, which started out as CarsDirect.com. So this idea started when Bill was very frustrated with the new car buying experience, which probably all of us have gone through these pains where you go to a car dealership and at least a half a day, if not a full day later, you walk out with a car. It just takes forever and there's just a lot of paperwork. And so Bill's idea was to start a company called CarsDirect.com where you could just go online, research your car, find the car you want, hit buy, go to the dealership, sign a piece of paper, and at first it was have the car delivered to you, and then it became go to the dealership, sign, and drive off very quickly. And so the early sort of proto idea was, and we very much subscribe to the lean startup methodology, as we were talking earlier about lean startup and Eric Ries's methodology. So the idea was to he said, let's go ahead and just put cars up for sale on the internet. I want to see if people will actually put their credit cards down and buy cars on the internet, because I'm not convinced that they'll do that, but let's see. And then everybody said, but how are we going to fulfill those sales? He's like, we'll worry about that later. We'll have somebody go buy the car and deliver it to them. So sure enough, they put it up, and it's kind of like that ad on TV where everybody stood back and people are buying cars, right and left. And so it was a good problem to have, and there was a concierge, obviously, effort to go out and buy cars and fulfill those sales by delivering them, and that validated the model, obviously. And so afterwards we turned that off really quickly, refined it, and it became the business where you would go to the dealer to buy the car and handle it that way. Because the business was so much lead generation, they morphed sort of in 2003, 2004 to Internet Brands, changed their name to Internet Brands, and focused on lead gen for a number of different verticals like travel and leisure, obviously the auto industry, education, finance, banking, mortgage banking, that type of thing. And then Internet Brands, which CarsDirect missed the first wave of tech IPOs in the late 90s, but basically picked up and went public in 2007, right before the 2008 credit crisis. Obviously, there was a downturn in IPOs, so timing was obviously very fortunate for them. And then in 2010, a private equity firm basically came in and bought all the shares and took them private, and that ended up being $100 million plus liquidity event for Idealab based on our shares. So not quite the same size of return that we got on the Overture, but nonetheless a very successful one. And then just to show you that no idea is crazy enough for Idealab, we actually, another passion that Bill has had is clean tech, mostly solar energy companies, but also an electric car company. So in 2006, we started a company called Aptera, which is basically a very lightweight composite material three-wheel car that is powered by a battery, so electricity. And as you can see, it looks nothing like the autos that you see on the road, but we like that. We thought that this was going to be a revolutionary automobile that would basically, because of the lightweight and the energy efficiency and the radius that it could go, basically change the electric car market. Interestingly, at that same time, Bill was interested in putting a lot of computing power on the car to basically take photos of the surroundings, and that was really sort of the onset of the whole idea of autonomous vehicles, was now that computing power was possible, putting that technology on these cars. So our first sort of Aptera cars had a lot of those capabilities. They weren't fully autonomous, but they were going in that direction. Unfortunately, they lived through the 2008 sort of credit crisis, but did not survive past that. They were trying to raise government funding. Another big company called Tesla was very successful in raising government loans. Our company, Aptera, I think because it didn't look and feel like a normal car, didn't really gain a lot of traction with the government in terms of getting loans, although we tried very hard to get loans from the government. And so it failed, but I think a lot of the autonomous vehicle technology that we started tooling around with has come back around, and we're starting to look at that sort of market again as something that's very intriguing to us. So those are just examples of sort of three, sort of groundbreaking ideas that challenge the status quo. Is every single company that we have going to be so earth-shattering and groundbreaking? Probably not, but these are three good examples of ones that have had that impact. So I've already sort of alluded to it. Our founder, the heart and soul of Idealab, is Bill Gross. He's a Caltech graduate. He's an engineer by background, but Bill is a very tremendous businessman, marketer, prototyper, idea generator, scientist, you name it. He sort of runs the gamut in terms of his capabilities, both technical and sort of business side. And he's very passionate about starting companies. So the background of Idealab and sort of the short sort of story about how Idealab got started is Bill was running a company called Knowledge Adventure in the early 90s that did a lot of children's educational software. In fact, Jumpstart was the name of the technology, the children's education software program that he marketed. Knowledge Adventure grew during Bill's sort of leadership to a $200 million, 300-person company, and he loved seeing it grow, and he loved having a big company, but he really sort of enjoyed the early stages of the company. He liked sort of that initial spark and that creation and just the innovation that happened early on. And then when the company was generating over $100 million in revenue, there was a lot of pressure to increase quarterly sales and net income, and all the pressures of business come in. There's sort of political things. The team is huge, and he really didn't. That wasn't really his idea, was to continue to run a company like that. So he sold the company, had a successful acquisition, and in late 95, early 96, he basically thought, okay, what's my next thing that I want to do? What's my next business? And he thought of Idealab. He thought, I love that initial spark. So if I could start 10 companies a year and see that spark and help them grow, and then eventually when they grow to be large, then they sort of move offsite and sort of manage their own affairs. That's what I want to do. And the business model fit really well, because if we create the ideas internally, we own them outright. We own 100% of the ideas. And so to the extent that we can grow the value quickly, we can basically have the returns that I talked about with Go2. So he's just very passionate, and he really is, he does have a list that has, I was talking outside to some of the folks, he has a list that has hundreds of ideas, anything from 2-word phrases to a paragraph. And it's Idealab's job to basically sit with Bill and the management team and the board to some extent and brainstorm about which of the ideas are, viable businesses that are scalable and can grow versus, hey, Bill, this is a great science project, but you're never going to be able to market it or make any money off of it. And that's hard, because when he gets passionate about something, he really wants to push it and make it into a company. We have had teams of various sizes that are charged with prototyping Bill's ideas, so we'll go cull through his list and find maybe the 5 to 10 ideas that really resonate and we think that can scale. And really, one of the main things that we're looking about is financeability. So is this an idea that can, be funded with, seed money in the amount of $250,000 to $500,000, and really in a frame of 3 to 6 months grow to be something that VCs would be interested in putting more seed money and eventually a Series A round. So we've had teams that basically focus on protoing ideas, 3 or 4 ideas at a time. The other model that we've used with success is basically allowing Bill and the management team to find a co-founder right out of the gate. So because our network from 21 years is basically very large, not just in the Southern California area, but all across the nation, we can tap into a huge network. And if Bill, for example, knows that there's folks out there that might that share his passion for a specific idea, he might bring them in as a co-founder. And yeah, we'll give up a little bit more equity to do that, but we think that the returns are still large enough that that's an attractive way to do it as well. So we've had 21 years in operation. We just celebrated our 21st birthday in March of this year. That basically started on Pi Day, 314. So from Caltech, I guess that was an inside joke. We've created and invested in more than 160 companies in our history. Those companies have created over 10,000 jobs, not just in Southern California, but in the Bay Area, on the East Coast. We've had a few international companies. And then over and above that, if you look at sort of the Idealab network and all the co-founders and executives and folks that have basically had successful exits out of Idealab companies, they've gone on to start their own companies in Southern California, San Francisco, you name it. And so there's a whole tree of sort of grandchildren of the Idealab children that is spread out across the community. And Lord knows how many jobs that much larger network has created. We've had very successful fundraisings for our companies. We definitely help them at the very early stages on a day-to-day basis with their fundraising, and Bill is a big part of that at the seed stage. And then they obviously go off, and sort of those teams are more responsible for raising the Series A and later financing rounds. And then the portfolio at any given time is 35 to 45 companies strong. Right now we've got about 40 plus companies in the portfolio. There's been about 45 successful IPOs and acquisitions. In the late 90s, obviously IPO was the exit event that we were all looking for. Coming through to today, you don't see as many tech IPOs, although the market is opening up with Snap going public and obviously Trade Desk up here in Ventura going public, and a lot of successful tech IPOs recently. We hope that changes, and we certainly hope to have more public companies in our portfolio. But right now, the strategy is to have sort of M&A acquisitions, and that's the exit that we're looking for. And so to give you sort of an idea of the exits that we have had, it's basically a who's who of sort of large technology companies. So we had a company called Picasa, which is a digital photo management software that was acquired by Google. And that was pre-public Google. So we got pre-public Google stock, and then I think a year after that acquisition, Google went public, and we held the stock for a few years and liquidated it. Unfortunately, it's trading at about 5 times what we liquidated it for, so we had some heated discussions back then about whether or not Google was going to get bigger, and we actually ended up selling, and they made us wrong. But anyway, you can never look back on those things. We did quite well on that particular investment. iRobot is probably one of our most recent acquisitions. They acquired a company called Evolution Robotics. So Evolution Robotics was a company that created a robotic hard surface floor cleaner. So this is a perfect example. You have a concrete floor, and so they had a robotic device that was about this big that had a Swiffer pad, and it would intelligently clean any hard surface floor like tiles, ceramic tiles, concrete, hardwood floors, you name it. And so iRobot, you guys may recognize as the creator of the Roomba, which is the carpet cleaning vacuum. And so we kind of always knew that our young, smaller company would be an attractive target for this larger public company. And sure enough, they came around and acquired Evolution Robotics for $75 million in cash a few years ago. And so that was a very successful acquisition. So you can see some of the others that are listed here. And then, this is really sort of history of Idealab. So back in the 90s, we had Overture and NetZero and CitySearch and eToys that I mentioned, Tickets.com, a number of IPOs in our past. So how are we doing on time here? So getting back to what Mike was mentioning about sort of the difference between what an incubator does and an accelerator and a VC firm, there's always misconceptions about what Idealab and an incubator is. So I try to sort of define it, A, by what we are, and B, by what we're not. So what we're not is we're not Shark Tank. So you've probably seen on Friday nights, they have the Shark Tank, and external folks come in and pitch their ideas, and the sharks, basically bid on ownership stakes anywhere from 2 to 10% usually. I mean, the founders usually aren't willing to give up much equity. So that is not our model at all. So we use pretty much strictly internal ideas. That's not to say that we won't have a Shark Tank-like investment in our portfolio, and I'll talk about that in a second, but that's not the norm. The norm is to use internal ideas. And then also, we like to control the companies, so we like to have greater than 50%, and to the extent that it's our idea, we have 100%. So we're looking for both internal ideas and large stakes. The reason that we might invest in an external idea is, a couple of opportunistic reasons. One is our network, as I mentioned, is very vast, so we might have CEOs, co-founders, CFOs, others that come back to us, 5, 10 years after they've left Idealab and say, hey, I'm starting a new company and here's the pitch, is Idealab interested? And only if it's sort of early stage and a really good fit, maybe it's an idea that Bill has but doesn't have resources to devote to it, or it's very close to an idea that he has, would we invest? And typically those are smaller investments, and those generally are smaller stakes. So the network, we do go to conferences, startup weekends, TED, all the tech conferences. We pretty much have somebody from Idealab at. And so to the extent that we meet somebody there that has an idea that, again, fits really well with our idea list and is something that we feel we can add value, we will talk to them about sort of doing something. And then at those events, we call them the rock star entrepreneurs. So we've had a couple times where we've met people that are just so impressive that we may not be interested in their company or their current idea, but we want to have them as part of our network. So we'll invest just to sort of get that relationship and hopefully either see that company to fruition or be able to do the next idea with them when they sort of move on. Idealab also is often confused with a venture capital fund. So we're not a fund, we're a C Corp, which basically means we're evergreen. So we try to take the liquidity events that we have and make a nice return to investors, but then fund that back into the business of creating new companies and having new ideas funded that way. Most venture capital firms are sort of finite-lived. Their mission is a 10 to 15-year life. They're going to take the funds that were invested into the VC and invest those in 20 to 30 companies during an active stage, and then they'll basically harvest that portfolio and make returns to investors. And then that's that life of that fund, and then they start the next fund and so on and so on. So we're not like that at all. We also have significant day-to-day involvement with the companies. So the companies, as I mentioned, are right on site, very similar to what you guys have here. They're right on site at our facility. We're involved with all the services for the company. We're involved in their strategy, at least early on. Whereas the VCs typically come in a little bit later during the revenue stages. I know there's different VCs that focus on different stages, but they, will come to the board meetings and they'll sort of put you in touch with accountants and valuation firms and lawyers that they use, but they don't directly perform any of those services like Idealab does. And then an accelerator. So we don't do anything in a sort of a class structure. New company creations happens in a flexible pattern. One year we might start 6 or 8 companies. The next year we might start 2. It just sort of happens when it happens. We don't have sort of classes that come in every June and we take applications or anything like that. So that's how we're different from an accelerator. And then there's obviously co-working spaces like WeWork and Cross Campus and things like that that are sort of a mixture of accelerators and incubators in the way they operate. So those are the sort of the main differences. So our business model, I think I've covered a lot of this already, is to basically test the ideas and look for innovative technology companies and sort of cull through those and put a little bit of money, and by a little bit I mean sort of $25,000 to $50,000 of money behind prototyping the idea, doing some market research, having some focus groups come in, going back to Lean Startup, putting together an MVP. Let's say it's a software app or a mobile app, seeing if there's any viralities, getting what validation we can early on to move to the next stage, which is creating the company. Recruiting the co-founders, I talked about that, but what I didn't talk about is that's probably the hardest step in the whole sort of chain of steps, is finding the right people that are the right fit for that particular company. But typically, we're able to do it. We had one interesting sort of event about 2 years ago called Idea Day. So you guys are probably all familiar with the startup pitch, where all the companies come in and they pitch their ideas, and then the funders and other entrepreneurs sort of gravitate towards that company, that specific company. So we did Idea Day a couple years ago, where we invited about 125 sort of local entrepreneurs and technology-focused people from all around Southern California. And Bill basically spent an hour and a half pitching 10 very broad ideas to that group of people in the hopes of finding co-founders, CEOs, CFOs, CMOs, basically the executive team to co-found the company with. It was a very unique event. It was kind of like a reverse startup weekend. And we didn't feel, we had a lot of discussions about, are we giving away sort of IP, but these were broad sort of ideas that we wanted to see if people were resonating around these ideas. And lo and behold, of the 10 that he presented, we actually, out of that Idea Day, had co-founders come together for 4 of them. And I believe one of those has failed, but the other 3 are still going and raising money. So it was a successful event, and we've talked about doing that again. But that just sort of is an example of how it's difficult to find sort of the right teams for the right ideas. And that's one sort of unique way that we tried to solve that challenge. And then it's basically, as I mentioned, nurturing the startups during the sort of pre-revenue stage. And then the model, as I'll sort of show on a later slide, is to get the high sort of return on investment for our early stage seed investment. So the new company creation folks, along with sort of the facilities people and the overhead folks, are about roughly half of Idea Lab. The other half of Idea Lab are sort of full-time services people. So we want sort of specifically the on-site companies to be focused 100% on their business proposition and not have to worry about, tomorrow tax returns are due. They don't have to worry about filing tax returns. They don't have to worry about running payrolls, creating websites, coding websites, that type of thing. They can just focus on 100% on their product, their proposition, their service, and leave that work to us, the sort of half of the folks at Idea Lab that are sort of full-time. So these are the sort of the back office services that we provide: accounting, legal, IT, obviously a roof over your head, facilities. We have a design team that helps with all design needs. We have PR folks that can help with press releases and so forth. And all of these people are sitting in the facility amongst all the companies. So, a lot of times the new companies come in, they're like, hey, I want to talk to design. Do you have the phone number? And I'm like, better yet, let me just walk you 10 steps across to our design team and introduce you in person. And so I think people really, enjoy the ability of doing that. And we do, obviously that's a business for us. We have service agreements with all the companies. We charge them each month for the services. In this day and age, the challenge for us is that obviously with young startups, focusing on these specific areas, you have payroll applications that are one-stop shop payrolls. You have accounting applications. You have legal applications that provide legal services. We need to be competitive, obviously, with those, and so we keep our rates, at a point where not only can we cover our costs, but we hope that the companies at the early stage can afford them and sort of take advantage of them. There's sort of an unwritten rule that, to the extent that we have an idea and we form a company, at least at the outset, they're going to use our services, during that pre-revenue stage, and it typically works out pretty well for them. So that's really sort of the overview of Idea Lab. I'm at 7:30. I'll probably take another 5 minutes or so just to talk really broadly about the incubator model, and then we'll move to Q&A. I think we're sort of running to the end here in terms of the presentation. So it's really all about sort of the speed with which you can grow the valuation of your company. And so sorry for the sort of eyeball chart here, but basically this is a cap chart of a company and sort of shows what a good, nice progression would be, from seed through sort of the various rounds of financing. So as you can see, the company obviously has a post-money, right around $5 million at the pre-revenue stage, $20 million at the revenue growth stage, 65 Series B, and then obviously through significant growth is raising money at a 180 post-money valuation. And the amount that the company's raising obviously is going up over time. Because of the increase in valuation, the amount of dilution, or the amount that the company is selling, is decreasing. So you see sort of the dilution impacting the founders and the incubator flattening off to the extent that you can get this increasing valuation. And then obviously the investors are also sort of flattening off as well in terms of their ownership. So the idea is obviously at the end of the day for that 250,000 seed stage investment to have, between 15 and 30% ownership, because if you can do that and have an exit of 250 million, 500 million, $1 billion, you've got a huge home run on your hands. And not every company is going to do that. Again, going back to the portfolio approach that I described, you're lucky if, 2 of the companies that you form in any given year, if you do, 10, 15 companies, you're lucky if 1 or 2 of them does that. And so the idea is that those home runs sort of cover the losses. And the timeline is very quick. So the creation seed stage is about 3 to 6 months, and then sort of the pre-revenue phase is 6 to 12 months. So basically, we give the company the seed money, and they have 9 months sort of at the earliest, and 18 months is really the outside range to really grow the value significantly and raise money. And it's all about Idealab sort of helping you do that and making introductions to VCs and really getting the company funded is sort of the number one priority as far as we're concerned. And it's really sort of de-risking, the low valuation at the beginning is because obviously there's tons of risk with the company. They haven't done anything, they haven't built a product yet. But as they build a product and test it and get market validation, the investors come in, that's where you get the valuation growth, is through the de-risking. So here's sort of an illustration of, in that sense where you were able to follow that pattern, how the incubator at 250,000 investment, if there's an exit at just the Series C, $180 million sort of last round financing, the incubator gets 31 million, which is basically 123 times return. So that's a huge return. And then if they're able to get 250 to 500 million, obviously the incubator gets 40 to 85 million, and over 300 times return. So you're basically, obviously, with an incubator portfolio looking to do that. Whereas the VCs that are coming in Series A through D, they're looking for a 3 to 15 times return. And they know that their return is going to be smaller because they're coming in when there's less risk, obviously, and higher value. The one protection that they get for taking, that higher valuation is they get the downside protection. So, there's the sort of notion of last money in is first money out. So the big VCs that come in the later rounds, will always get that liquidation preference and the rights to get their money out first. So to the extent that the company fails, which nobody's in the game for that, but to the extent that it does, they'll basically take in the assets, and the earlier stage guys won't get anything. But you'll learn from those failures, I guess, is a good way to put it. So the last slide I have is just obviously showing that portfolio sort of approach, and in just a rudimentary example of a 4-year, sort of 6 company per year early stage fund that's investing 250 to 500 per company. So they're creating 24 companies, and the Grand Slam, is returning $85 million at 300, greater than 300x. So that's really driving the results. And so when everything gets blended, all the successes and the losses, for a $10.5 million financial investment, there's a $200 million return at 20 times. Obviously, there's going to be cost to operate the entity. I estimate about $2 million a year. So 10 million over that sort of time frame. So for the 20 million investment, a 200 or 10 times return is sort of what the incubator model is looking for. Accelerators and co-working spaces, they'll have their programs where they're taking, in exchange for allowing you to sort of be housed in their facility and take advantage of the accelerator, they might take, a 6 to 10% interest, which is a minority stake. But if they're doing that hundreds of times, then chances are, if they get an Uber, in their class, or a huge success, a Snap or something like that, that's going to change the results for that accelerator, drastically. So that's really all that I had prepared. And I think timing-wise, are we on? So I am happy to sort of answer questions and give some more insights into sort of our history. Right here.
So do you ever take on mentors for your companies? Or is it just all employees, founders, co-founders?
We don't take on mentors in a large way. Like, we don't have a mentoring program, but the one way we do it is through our network, and to the extent that we know somebody that would be a good fit for a particular company, but they're gainfully employed, so we can't sort of woo them away. If we think that their advisement would be, valuable, and we're sort of close enough to them, we will sort of try to bring them into the nest, as it were, in some capacity, but that's really not sort of our core sort of capability, but certainly if we know folks, we will bring them in.
One more? Somewhere a lot of incubators will have to kind of shut down successful companies that are growing but not growing at the rate that you want them to. Is that a struggle for you guys? Like, how do you deal with something that is still potentially successful but not a wildly successful company? What do you do with that IP?
Right. No, it's a huge deal. A little bit more for the fact that we don't want to give up control of the company too early. Like, if it's so the two examples of that are Overture and then Overture Policy. So there were a lot of struggles. So Yahoo came up with $1.4 billion for Overture, and so a lot of people thought, well, that's not enough. Like, it's going to be a huge market-changing company, right? So the problem is that at that point, a lot of people sitting around the table, financial investors that are looking at it going, "Oh, you're crazy! This is going to make my fun." So there's a lot of forces that work there. So that was one thing. Which Robotics was a little different because we had a little bit more control over that company. They were generating, $25 million in annual revenue with their robotic vertical there. They had sort of aspirations of being an Internet of Things company where this device was one of many that was going to manage your house using IoT and robotics technologies, right? And so that vision was way bigger than a Roomba vacuum cleaner, right? And it's interesting to see now iRobot is sort of starting to say, hey, we're getting into exactly this. And I think that's more than just cleaning your house. It's humane. So, look, if we've grown the company at its plateau, then we'll do everything we can to sort of get a nice acquisition for that, that market. And it's usually the opposite. It's going to be a much bigger sort of outcome than we get out to. So let's give Craig a round of applause.